What if I told you that one single political headline dropped on a quiet weekend morning, vaporized billions of dollars from the crypto market before most people even finished their coffee? We're talking about October 10th, a date that altcoin holders probably still flinch at. Here's the setup. Tariff threats rattled global markets, but because major US exchanges were closed for the weekend, that fear had nowhere to go except straight into crypto. The crypto market, unlike your local stock exchange, never sleeps, and on that morning, that was a very bad thing. Think of crypto liquidity like a swimming pool versus the ocean. Bitcoin is the ocean, deep and hard to drain, but altcoins are kiddie pools. When panic hits, the kiddie pool empties in seconds, and everyone's standing there soaking wet wondering what just happened. The liquidation cascade worked like dominoes, set up by someone who really hated altcoin holders, leveraged positions, got margin called, which forced selling, which pushed prices lower, which triggered more margin calls. In a matter of hours, some smaller tokens dropped 30, 40, even 50%, while Bitcoin shrugged and dipped, maybe 8. What made this hurt so much psychologically is that going into October, there had been genuine optimism, whispers of altcoin season, charts looking constructive, community vibes were almost annoyingly bullish. Then one tariff tweet-adjacent headline later, the hopium evaporated faster than a meme coin roadmap promise. Analysts like Noel Atchison have long warned that altcoins are essentially high beta sentiment proxies, meaning when confidence wobbles, they don't just fall, they faceplant. And yet every cycle, we collectively forget this, put on our rocket emoji hats, and act surprised when gravity reintroduces itself. Here's what history keeps trying to teach us. March 2020, the COVID crash, FTX collapse in 2022, the China mining ban. Every single one of these felt unprecedented in the moment, and every single one followed the same basic script of macro shock, liquidity drain, altcoin massacre. The faces change, the tokens change, the excuse changes, but the pattern is basically wearing the same outfit. This October 10th event fits neatly into a well-documented cycle where macro uncertainty forces capital rotation from risk-on speculative assets back toward perceived safety. Bitcoin, cash, or just the couch. It's not random chaos. It's a predictable, almost boring reallocation that the market runs like clockwork every time adults in suits start arguing about trade policy. Now let's kill a misconception right now. A lot of people think altcoins got crushed because they're scams or fundamentally broken. And while, sure, some of them absolutely are, that's not why they fell harder. It's purely structural. Less liquidity, more emotional holders, and thinner order books mean any selling pressure hits like a freight train instead of a gentle nudge. The practical lesson here isn't to swear off altcoins forever like some scorned ex, it's to respect position sizing like it's the 11th commandment. If your altcoin bag represents more of your portfolio than you could stomach losing entirely, you've already made the critical mistake before the market even opens. Disciplined investors who survived October 10th largely did so not because they predicted the tariff headline, but because they sized small enough that the pain was manageable and kept dry powder ready for exactly these kinds of irrational sell-offs. Strategy beats conviction every single time. Conviction is just ego wearing a trading jacket. The traders who fared worst were the ones running maximum leverage on low-cap tokens because they were sure about a catalyst. And the market, as it loves to do, took that certainty and composted it into a lesson. Process, patience, and position size are the only 3 things you actually control in this game. There's a philosophical truth buried in all of this. Markets are just giant machines for humbling overconfident people. And October 10th was simply a very efficient session of that machine doing its job. The altcoins that survive these events and actually recover are the ones with real liquidity, real communities, and real use. Everything else is just noise waiting to be silenced. Honestly, if you zoom out, events like this are healthy. They flush out speculation, reset expectations, and occasionally create the kind of entry points that future you would thank present you for taking advantage of rationally and calmly. The investors who came out ahead weren't the ones who panicked or the ones who doubled down blindly. They were the ones who had a plan before the chaos started. So be comfortable with volatility, not because it's fun, but because discomfort is the tuition for every lesson the market teaches you for free. And if you've got a disciplined process, the right size, and patience measured in months, not minutes, and October 10th isn't a disaster, it's just a data point. And if you're ready to put that same discipline to work in assets that don't have weekend liquidation cascades, whether that's real estate investing, home contracting projects, or finding the right lenders, check out our links in the description below and let us help you get started.